Hey there everybody. This video is going to be a review of our practice set to give you a little bit of direction about how the accounting cycle operates, and we'll discuss some of the individual components like adjusting entries and closing entries that are sometimes problematic for students when working through this stuff. So I first want to turn our attention to the instructions. Basically, this is kind of a breakdown of how we work through the accounting cycle, how information flows through an accounting system. So I want to go through this step by step so you can see how all the different information kind of interrelates here. So notice initially we were given a chart of accounts for this company with all the different assets, liability, and equity accounts. And the first step in the process is to analyze each transaction and then record it in the journal. So we have a list of all the different transactions that affected this company. And this is the first month of operations for this particular company. So they're brand new. Before this process, they had no accounting records, no transactions had been recorded before the very first one. So our first step in the process is to go through and look at each one of these transactions, identify which accounts are being hit, determine which one's going up, which one's going down, and then make the appropriate debits and credits. So notice the very first one, our owner here, Homer Simpson, deposits $75,000 of his own money into a new checking account to start the company. So this is the first transaction that affects the company. We could see the journal entry here that we have cash being increased, so $75,000 debit. Of course, we know when an asset goes up, it's a debit to that account. This is the first thing that has happened to this company, first financial event. So the company now has ownership over that asset, cash. And also the equity account, capital goes up $75,000. Remember, if we're dealing with a sole proprietorship, we use a capital account. If Homer set up this company as a corporation, that would be a common stock account. Both are the same idea. Owners are contributing money to fund the operations of the company. So basically, for each of those transactions you had, you're going to go through that process all the way till the last transaction we have, and you're going to book all of those in your general ledger, or general journal, I should say. The next step in the process is actually taking that stuff from the journal, then posting it to the general ledger. So notice we go back to the steps in our process. Number 2, post the transactions to the general ledger. Remember, the journal is basically kind of a running tally, a journal diary of all the transactions affecting the company. So notice in the journal, they're listed day by day. Here's all the transactions that affected us on the first day of the month. We could see on January 3rd, we had a transaction. So notice if you're looking to see what transactions occurred for a certain period of time, you would go to the journal. But the journal doesn't give us balances, so I can't tell directly how much cash the company has from looking right at the journal without doing some extra work. But we do have the general ledger that gives us that information. So the general ledger is just showing each account in the company. It's a running tab of all the transactions affecting each account. So notice we have the cash accounts, receivables, and these are just going down in the order that they appear, all right, on our chart of accounts. So if we notice for that very first transaction, we post it from the journal to the ledger. So basically what you're going to do throughout the month, you'll make all of your journal entries. Then at the end, you could post these to the general ledger. So we'll look at the very first one and see how this is done. So we took the cash amount of $75,000. We go and we find the cash account in the ledger. And that was a debit to that account for that transaction. So we have a $75,000 debit. And over here, the second set of columns, that's our total balance. So we know cash went up. Right now, after that first transaction, the balance is $75,000. We'll see there's another transaction on the first where we spend $30,000, so that's a credit. When we post that, our new balance after we go out and buy that truck for $30,000 is now at $45,000 balance. So general ledger gives us a running total of all the balances for every account we have. Now notice these post-reference columns we use here. All right, we got this information about this transaction from the first page of the journal. So notice here, page 1 is where we made this entry. So when I actually post this information into the ledger, I just put the J1. Notice some of the later transactions down here, or J2, they came from the second page of the journal. And likewise, I take the account number, the 101 in this case, and I put it in the post reference column here for the journal entry. All right, so we do that every time we post to the general ledger from the journal. All right, we're going to fill out the post reference column like that. So this is kind of a check. If you see the numbers been posted, you know that you've moved those numbers from the journal to the ledger. Now, the second part of this transaction, we had a credit to capital, so we would go and post that. Notice I've posted all the information here already. I'm just kind of reviewing it at this point. So we're going to go down and find our capital account. Notice on January 1st, we had that $75,000 credit. So after that transaction, the total balance to capital is $75,000. So we could see again that came from the first page of the journal. So we used the J1 post reference, and that was account 301, which is right there. So we do that same process for all of our journal entries we make. We post them to the general ledger. Now, once we're done posting everything to the general ledger, then we're moving on to step 3, preparing the trial balance section of the worksheet. And the trial balance is basically kind of a check on our work to make sure that we did everything correctly. So we want to see that all of our debits and credits equal. Remember, for each transaction, the debits and credits have to equal. So overall, for all the transactions, debits and credits should be equal. So what we're going to do is take the balances from each account after making our initial entries. Notice cash. We made all of our journal entries, posted the GL after that last entry from those transactions. Cash had a balance of $48,051. So I bring that over and I put that in the trial balance column in the worksheet. And I'm just doing the same thing. So at this point in the process, we haven't made any adjusting or closing entries. Those are going to come later. We made our original entries, and we're just going to take the balances from each account from those entries. All we're doing is bringing them over, all right, from the ledger to the trial balance. Notice 6150 in receivables. That's a debit. That's the next one. And we just have kind of a running tab, all the debits, all the credits. And then at the end of the day, our debits and credits should equal. All right, so if the number is off in the trial balance, that means we made a mistake somewhere back in either making journal entries or posting to the general ledger. So if those numbers don't equal, we need to go back and check our work and figure out basically where we messed up. Now, the next part of the process is the adjusting entries, and this is one of the trickier parts of the process. So I'll spend a few minutes talking about these adjusting entries. Notice we had 3 of them we actually had to work through here, and all of these are deferred expenses. So we could see here we bought some supplies earlier in the month. We didn't use all the supplies initially, so we created an asset. So at the end of the month, we're going to take an inventory, figure out how much we used up, and then we're going to record that expense during the adjusting process. Likewise, we had some prepaid insurance. We're going to make the adjusting expense entry for that, and also our depreciation on equipment. So let's look at each one of these. First off, the supplies that we used up. So notice if we go back to our journal, we had made an entry recording the purchase of supplies at some point here. So we bought, it was actually on January 3rd, we bought $2,800 worth of supplies. So we made this entry. This is one of the very first things we did. We had a debit to supplies, a credit to accounts payable showing that we need to pay this back. We bought them on credit, so didn't pay for the supplies immediately. Note, I didn't take an expense there. So right now, I'm showing that I have $2,800 worth of supplies in my company. So that's what would show up on our balance sheet as the amount of that asset if I didn't make any adjusting entries. Now, we may have used some supplies during the month, so we want the balance sheet to accurately reflect how much we have in the supplies account. And also, we want to recognize any expense. If we used up the supplies, that's going to be an expense at the point when we use them up. Now, if I would have bought like $100 worth of supplies and I thought I was going to use them all during the month, when I made that original entry, I could have just hit supplies expense right then, but we're thinking we're going to use these supplies for multiple periods. So we have this idea of the matching period, the matching principle. We want to match expenses with a period in which they help us earn revenue. So we're going to be using these supplies over multiple periods. So basically, we're spreading out the expense of those supplies over multiple periods. That's what our adjusting entry is going to do for us. So if we look at the directions again, basically, we took an inventory count. We had $2,800 worth of supplies at the beginning of the month. We go to our supply cabinet, count up the value of the supplies left, and we have $2,500 left. So basically, we used up $300 worth of supplies. So in our adjusting entry column here on the worksheet, we need to reflect that. Notice the total amount of supplies is going to go down by 300, right? We only have 2,500 left at this point. We started with 2,800. Well, we need to reduce that by 300. That's why we have the credit to the asset. And then our new balance in that account is 2,500. So we're going to make the journal entry a bit later. At this point on the worksheet, we're just kind of plotting out what we're going to do in the future. So the worksheet's kind of like scrap paper if you're working through a math homework or a math test or something. We haven't really entered this into the official records. The journal, the ledger, those are official records. The worksheet's kind of a check on our work. And notice the other part of that, we have supplies being hit. Well, we need to recognize supply expense at this point. Remember, when expenses go up, that's always a debit to the expense account. So likewise with prepaid insurance, remember, we paid for 6 months worth of insurance in advance. So if we look at our original entries, we have that here, the first day of the month. We sent out a check to our insurance company for $1,800. Maybe we're paying for insurance on this truck for 6 months in advance. So we're going to use that insurance coverage over 6 months. So notice I did not hit insurance expense yet with this transaction. We recognize we have less cash. We made a payment, so the amount of our cash on hand goes down. And I created this prepaid insurance entry. So basically, prepaid insurance is showing the insurance company owes us 6 months worth of coverage as of January 1st. So we made this entry originally. Now it's time to make the adjusting entry. We always do these adjusting entries on the last day of the month. All right, well, we're no longer owed 6 months worth of insurance. We paid for it up front January 1st. Well, a month has gone by, so we've used up 1 month of that prepaid insurance. If you take $1,800 and divide it by 6, basically we're paying $300 for insurance each month. We just paid the whole amount up front. So that's why we have to do the adjusting entry for this particular transaction, because we paid in advance. Again, it's that matching principle at play, right? We paid on January 1st expense that's going to cover us for 6 months. So we don't immediately expense it. We slowly take the expense over time. And that's what we're doing with our adjustment here. So prepaid insurance, notice it started at $1,800. That was our original entry. Well, that's how much insurance coverage we were due at the beginning of the month. Now we're at the end. So we used up a month of that coverage. Well, $300 has been used up. The insurance company still owes us 5 months worth of coverage because we paid in advance. By the end of January, they owe us that amount. So after we have the credit of $300, the new balance that's going to show up on our balance sheet for prepaid insurance is $1,500. Flip side of that is we have to take insurance expense, right? We have a credit to prepaid insurance. We're going to make a journal entry here in a minute to reflect this. Well, credits and debits need to be equal. So we have insurance expense. Remember, again, an expense gets debited. So that was 2 out of our 3 adjusting entries. The last one is depreciation. So we bought a truck and a snowplow on the first day of the month. Notice again, if we go back to our original entry that we make in the journal for those 2 items, we didn't hit any expense accounts. We hit an asset accounts. One we paid cash for, so we reflected the fact that we have less cash. The other one we bought on account, so we reflected that here. Showed that our accounts payable went up. So again, that matching principle wants us to match expenses with the actual period in which they helped us earn revenue. So this truck and snowplow we're going to own for a number of years. It's going to help us earn money for years. So I don't want to take the full expense in January when I bought it. I want to slowly expense it over time. That's what depreciation does. And notice in our instructions, it tells us we estimate we're going to have the truck and snowplow for 5 years. So slowly over 5 years, we're going to spread out that initial cost. Even though we paid for it right in January, we're going to slowly spread that out. So we use our straight line depreciation calculation. And remember, when we do that, we look at the value of the equipment. So those two items together, we paid $31,274. And we're told in our directions we have a salvage value of $2,000. Basically, that's what we think the equipment's going to be worth at the end of the 5 years. So we subtract that. And notice we're doing a monthly statement here. So we have it for 5 years, but I'm looking at how much expense I'm going to take for this particular month. So I take the number of years, 5 times 12, and I'm basically dividing by 60. So the amount of depreciation I'm going to take each month is $487.90. So we can see here that's going to be a debit to depreciation expense. That's how much we're going to recognize this particular month. And the other side is that we make that credit to accumulated depreciation. That's called a contra asset account. Notice every other asset has a debit balance. Accumulated depreciation has a credit. We kind of match that, net that against the equipment to get the net value, looking at our original value of the equipment, subtracting out how much depreciation we took, and that shows us the current book value that's on our balance sheet. So those were the adjusting entries that we had to work through. Again, we haven't made journal entries for those yet. So a little later in the process, we're going to go and take these numbers, make the actual journal entries, and then update the general ledger for each of those accounts. Notice step number 9 is where we actually do that. We just finished step 4, so we're going to move on to step 5, completing the worksheet. Basically, you finish completing your adjusted trial balance. All that's doing is bringing all your numbers over from the trial balance. Notice if you had an account like cash that didn't have any adjustments, you just bring the number over, right, from the normal trial balance, just transpose it, transcribe it over to the adjusted trial balance column. And then any transactions for accounts that had adjusting entries, well, you find the difference, you take into account the adjustment. Remember, we had $1,800 in prepaid insurance after our original entries in the journal. Well, we're going to subtract $300 from that, so we just net the debits and credits. We bring that over, and basically we're going to continue that process. And we add up our credits and debits, make sure they equal. For our adjusted trial balance, if it's good, we continue on with the process. These last two columns, or two sets of columns, are just separating out our income statement accounts from our balance sheet accounts. Remember, the balance sheet's going to show our assets, liabilities, and equity. So any balances that go with those accounts, we bring over to the balance sheet. Remember, the income statement shows expenses and revenue. So any expense or revenue accounts, we just bring over here. So these last 4 columns, we're just taking the stuff from the adjusted trial balance and kind of replicating it, just breaking it up. And that's going to help make it a little bit easier when we actually prepare our financial statements. Notice steps 6, 7, and 8 are actually preparing the financial statements. And that's the whole goal of this process, right? To kind of create these financial statements so we have good information to use at the end of the day. And we could see here with our financial statements, our income statement here, we list out our total revenue, our fees income, $16,850. Again, I could just look at that income statement set of columns here on the worksheet. We have our fees, $16,850. So I'm just bringing that over. Then I'm going to list out all my expenses. So notice salary expense $300, utility expense $65. I'm just bringing those over to the income statement here. And all we're doing is taking our revenue minus the total of these expenses. The difference is our profit, our net income. So Homer's company made $13,063.10 in January. So that was their profit. That's what the income statement shows us. Remember, it shows for a period of time. So for the month ended, this is how much profit we made for the month. The next statement is retained earnings. Remember, we need this net income to figure out retained earnings. And actually for Homer's company, they don't explicitly have a retained earnings account. So notice we go here and look at owner's equity. We do have capital, so some smaller companies don't separate out retained earnings. So we're just going to take this straight to the capital account when we make our entries here. So we could see that we started with $75,000 in capital. That's his initial contribution. Well, we had to do the income statement first because we're looking at how much we made. We're looking at how much capital increases. Remember, owner's equity increases if we have a profit, so it's going to go up because of that. But Homer also withdrew money from the company at the end of the month. So that's going to make capital go down. So we go up 13,000 and change. We go down by 2,500. In total, our capital is going up 10,563. So we're taking the 75,000 plus 10,563. Our new capital is going to be 85,563 here. Now, notice we did have a retained earnings account. We could do this in a little bit different way. We could have retained earnings that starts from the first day of the month. Let's say 1/1. Well, remember, first day of the month, we haven't done anything yet. Retained earnings is just how much of your former profits you've kept in the business. So on that first day of the month, it would have been 0. Then we add our net income. All right, so 13,063. And then we're going to subtract out any drawing, which we had 2,500. So if Homer had a retained earnings account, we didn't lump it into the capital account, this 10,563.10, all right, that would have been the total retained earnings for the company. Because he doesn't have that separate account, we're just basically taking the retained earnings, doing it a little bit differently, adding it to the original capital, and that gives us our new capital amount. So equity is just kind of the subdivision of capital and retained earnings. In this case, we're just kind of combining them into one particular account. Notice the balance sheet. We're just taking our assets, liabilities, and equity, bringing them over. We have all of our assets listed first. Notice there's that equipment with the accumulated depreciation. So you got to subtract the accumulated depreciation from equipment, get your subtotal. All of our assets come to 88,987.10. Remember, the balance sheet, the balance part of it comes from the fact assets equal liabilities plus equity. Remember our accounting equation. So we have to make sure that's still in balance. Well, we have assets of 88,987.10. Notice our liabilities here, we just have one account, 3424. All right, so assets need to equal that liability amount plus our equity. And we can see our equity is 85,563.10. So basically, if we add those two numbers up, they come to 88,987.10. So that's exactly what we got for assets, right? Our assets equal liabilities plus equity. So we're in balance. That's a good sign to help us have confidence that we did our work properly. And notice again on the balance sheet, this is for one point in time. So the balance sheet is a stock concept versus a flow concept for the income statement. Income statement looks at revenue, expense, and profit earned over a period in time. The balance sheet looks at how much assets, liabilities, equity we have at one particular day in time. So that was kind of the end result of what we wanted to do for this particular month. Last part of the process is posting those entries, adjusting entries, and making our closing entries. So if we go here and look at our instructions, all right, part 9 is journalize and post the adjusting entries. So we could see that here in our worksheet. Again, we have that in the adjustments column. I'm just taking these numbers and now making journal entries for them. Remember, supplies, we're going to make a $300 credit as the adjustment to supplies and a $300 debit to supply expense. I'm just going to bring those over to the journal. And notice in the journal, I've highlighted our adjusting entries in yellow. You did not need to do this for your project, but I just wanted to kind of highlight where these are showing up. Notice those are those 3 entries. We did the hard work of figuring out what entries we need to make on the worksheet. Now we're just bringing those numbers over. Now remember, we need to update this in the general ledger as well. So everything that we have here for an adjusting entry needs to be updated in the ledger. Notice the supply expense, 300, supplies, 300. We're going to see those are updated here. All right, so notice we go to supplies. There's the adjusting entry right there. We had $2,800 in supplies. That was the initial entry we made on the 3rd. Now when we post this adjusting entry on the 31st, all right, we have a $300 reduction. Our new balance in supplies is $2,500. And notice that makes sense. That's showing, all right, what we actually have in supplies on our balance sheet. So we're going to do that same process for the other 2 adjusting entries. Make the entries in the journal, then post them over to the ledger. Now, next step we want to do is the closing entry. So remember, we're kind of done with January's work right now. We've created the financial statements already. Next part of the process is we want to wipe out those temporary accounts. Remember, revenue, fees, accounts like that, expenses, our drawing account, those are all temporary accounts. They need to be reset at zero. Because remember, we did our income statement already. We showed, how much income we had, right? How much revenue, expenses for January. We want those accounts to be reset to zero when we do February statements. If I look right now in my ledger, for instance, let's look at our fees income account here. We scroll down there, we're going to see there's still a balance before we make our closing entries. So notice this blue is my closing entry. These were all of our original entries during the month. After the 28th, I had $16,850 sitting in the fees accounts, right? I need that to reset to zero because in February, I need to start from a fresh slate. So the closing entry is going to close this out. I have a credit balance to fees. Well, I need to make a debit to that account. So first thing you're going to do is make a journal entry. I'm just showing you kind of what the GL looks like. But I would be at this point here, I'd see I have $16,850 credits. Well, I need to make an entry to clear that out to get it to zero. So we can see here in blue are our closing entries. Well, I'm going to make a debit to fees. Flip side is we use income summary, this placeholder account during the closing process. So if I make a debit to fees, I have to make a credit somewhere else to make this work. The credit goes to income summary. So we can see then we're going to post that to the ledger, and that's kind of what we looked at already. Notice this blue line here. After we make that entry in the journal, I come over here and I update it. And notice my new balance is zero. I had a $16,850 credit balance. We looked at that to figure out what the closing entry needs to be. Well, that tells me I need to make a debit. All right, a debit is basically like a minus, so we had plus $16,850 in fee revenue. Well, I'm subtracting it out. Now it's zero, and that's great because when we come to February, we're just going to kind of pick up. If we had a revenue we earned on February 1st, I'm going to enter it in here, February 1st. Let's say we earned $1,000 in revenue. All right, our new amount for February is going to be $1,000. All right, notice if I didn't close out that $16,850, all right, I would be at $17,850 in total revenue, which is, we don't want it to look like that, right? Because we want to look at, well, how much revenue did we earn in February? So we needed to close out that account. Same thing with all of our expense accounts. Notice here, salary expense. Remember, expense accounts are going to have debit balances every time we incur an expense. It's a debit, so we're going to need to make credits to all these expense accounts. So notice this is the GL posting for my closing entry. So let's look at that entry here. All right, so notice I'm making credits to all my expense accounts to turn them to zero. All right, so I look at the total number, add up all my different expenses together, it comes to $37,86.90, and that number should look familiar, right? That's our total expense amount we've seen over here. All right, so basically we want to close out all those expense accounts to zero. So flip side is I'm making credits to all those. I need to make the debit to income summary. So after you post this in your journal, once you make the journal entry, come over to the general ledger and update, all right, each account. Notice that's what I did on the 31st. This is my ledger entry. So I make this after I actually do the journal entry. And notice we do this for every one of our accounts here that has an expense. All right, we close them out. And you can see we highlighted this in blue. Notice utility expense. On the 17th, we paid some type of utility bill. We recorded the expense on that day. Well, we want to reset that temporary expense account to zero, so I need to make a credit to it. All right, so that's what we did over here. All right, we had the $65 credit. All right, so we do that to close out all the expenses. So first two parts of the process in closing, close out our revenue. Second part, close out expenses. Now, notice in our income summary account, we actually have a balance now. We made two entries to income summary. All right, we had the credit of $16,850 and the debit of $37,86.90. Notice if we go and look at the income summary account, we could see that. So at that point, we have these first two entries. So after these first two entries, I have a credit balance of $13,063.10 in income summary. Well, this is a temporary account as well. We need it to be closed out. So what I'm going to do is make a debit entry of $13,063.10. All right, so that's what I do right here. Remember, it gets closed out to capital. If we had a retained earnings account, we'd close it out directly to retained earnings. So the $13,063.10, I make the debit to income summary, I credit the capital account, then I come over to the general ledger and I update this. So the whole project's already completed, so I'm kind of going back and forth between the completed pieces, but you'd see the first closing entry at the income summary you posted here. This is the second one after the second one. Once we're at this point, we did these first two. We're gearing up to do this third entry. Well, the third entry means we have to close out income summary. So I got to figure out what's in there. Well, if I kind of make a little T account and think about that, just another way of doing it. Let's say this is the income summary account. All right, well, we had a credit of 16,850. All right, we had a debit of 37,8690. All right, if I foot the account, remember footing means to kind of add the debits and credits. Well, I have more credits than debits. So in total, I have 13,063.10 in income summary. So I need to make a debit entry to clear that out, right? And that's basically what we were just kind of showing a minute ago, right? After the first two entries with the 13,063 credit, just basically the same as what we're showing here with the our little T accounts. So that's why we make the debit to income summary. And notice our capital goes up now. Basically, we're taking that profit, adding it to our capital at this point. Very last part of the closing entries, we want to close out drawing. If we look at that drawing account, all right, we're going to have $2,500 in there. Remember, on the 29th of the month, you made an entry in your journal to show that Homer withdrew money. So he took out cash. If we go back and look at that original entry that you made, remember, we withdrew $2,500 cash. So the company has $2,500 less cash. We have to record that. That's a credit. We debit drawing. So that drawing's a temporary account. So we see that here. We have the balance of $2,500 before the closing entry. We want that to be closed to zero as well. So we need to make a credit to do that. So in our closing entries, we have the credit to drawing and the debit goes to capital. All right, so we make that journal entry, then we update our GL here, and you can see what that blue is doing. So one last step in the process, preparing a post-closing trial balance. Once you've done all this work, once you've made your adjusting entries and posted them to the GL, once you've made your closing entries and posted those to the GL, now you do a post-closing trial balance, and you're just looking at basically what accounts still have balances, right? So if we look at most of these accounts don't have balances, right? Drawing is now zero after we closed it. Income summary zero, but some accounts do still have balances, the permanent ones like cash, right? This is how much cash I have on the last day of the month. Well, if I earn another $1,000 on February 1st, I want to add that to the beginning balance because I want to know how much cash I have at one day in time. All right, so if we have balances left in these permanent accounts, we bring these over to the post-closing trial balance, bring our debits over for the debit accounts, credits over for the accounts with a normal balance that's a credit, and again, we just add the credits and debits and hopefully they equal one another. So this is the very last part of the process, just basically checking our work to make sure that everything was done correctly during the closing process. All right, so that's a brief recap of the project. Kind of gave you a little bit of another highlight of how you do adjusting and closing entries. So hope that was helpful. If you have any additional questions, just let me know.